I'm joined here in the studio by Jane Foley. Jane's research director at Forex.com. Jane, thanks for coming in. Right. On the one hand, we have the Americans saying that they are in favour of a strong dollar policy. Then we've got the Japanese and much talk of a weak yen policy, and the roles should be reversed.
Well, I mean, you know, you look at US policy and you look at Federal Reserve policy, and they're saying that interest rates are going to remain low for a very extended period. You look at the consumer in the US and you see, well, you know he's saving more, you know he can't borrow more in the high streets because, because of the lessons from the subprime crisis have tightened up criteria. So you think, well, actually, if the Federal Reserve cannot sort of try and get inflation going with low interest rates in the US might be low for a very, very prolonged period, even beyond the second half of next year, maybe into 2011.
So we're talking about the experience of Japan in essence. Yeah.
You know, in essence, I think there are lessons to be learned. You know, I mean, I don't think that the propensity to consume of the US consumer will be as low as in Japan. So I think the US consumer will come back eventually. But certainly there are lessons to be learned.
You're almost hinting at the D word here.
Well, no, I'm not quite. But there are analogies there. All I'm saying is that there is a reasonable possibility that Fed rates could be low for a very long time. And if that is the case, and of course we've got this funding currency thing with the dollar extending for a longer period of time too, which of course leaves the euro and the yen, again, bearing the brunt of the dollar's downward move.
But what about the Bank of Japan? How does it deal with this situation? Do they come in here and start buying dollars here? Because they can't be comfortable with 85, 86 yen.
They definitely can't be comfortable. When you look at the fundamentals there, you know, you've got the government saying that they're in a deflationary mode. And also you look at the Nikkei. The performance of the Nikkei over the last month has been terrible. So you put those fundamentals together and they should be worried. Now, obviously, when this government first came into power, they didn't seem to be that perturbed, but they must be now. But can they intervene in an environment where the Federal Reserve is going to keep interest rates very low? Well, you know, will they be standing in front of a train? You know, can it work? You know, and I would be very doubtful. So they certainly have to start jawboning, but also it points the finger back at China and other regional...
Well, that's what I was going to come to, because we're talking about currencies which can fluctuate, but
yes,
the Chinese one cannot.
Yeah,
We've got the ECB president, Jean-Claude Rishaad, jetting into Beijing. Do you think he's going to get any joy out of the authorities there? Well,
of course, Obama failed. You know, we didn't have any reassurances from China when Obama was there, and that was just this month. So you can't blame the market for being sceptical, but they've got to go there and they've got to, you know, put their case in point. If you look at the effective exchange rate of the ECB, you will see, you know, that the weight of China is growing, and if you add to that, you know,
the peg to the dollar makes it even weaker, doesn't it? That's the point here.
Yes, I mean, for instance, if China were to revalue its exchange rate against the dollar, then you could have euro-dollar going beyond 150, you know, potentially up to 160, and it wouldn't be having so much impact on the effective exchange rate because obviously China would be taking some of the weight. And of course, it's not just China. You know, there are a couple of other countries in Asia which have pegged their exchange rates to the dollar. But not only that, you've got the likes of Korea intervening in the markets to try and protect their competitiveness against the dollar. But you could say that what they're really saying is that we're really trying to protect our competitiveness against China. So there are a lot of fingers pointing here to China. You know, it's possible that they're going to try and sidestep the issue until external demand has picked up, maybe to the latter part of next year. But certainly, I think it's right that the ECB and the Japanese put their case to them.
Yeah, I mean, there is an example here as well. We saw what happened in Vietnam with the central bank there deciding that they had to revalue the dong and or devalue the dong. Suddenly it slipped 5%. Some are talking about a 14% effective fall for the currency there. Is that something? Are we heading towards more, well, how can I say, turbulence on the currency markets in East Asia?
Well, quite possibly in East Asia. But I think really for the markets, the central thing has got to be China. And you know, if China doesn't go, you know, we are going to go and be talking next year through this theme again about asset price bubbles as well. And you know, then you bring up the attitude, the conversation about you know, how they're going to stop these inflows. That may not work either. So it can get quite messy and quite volatile. So potentially yes.